Hello, dosto. My name is Deepak, and I'm a tax code advisor. Today, we are going to talk about Sofi. Sofi is an online bank, but they're actually way more than a bank. They are now involved in mortgages, in credit cards, refinancing of student loans, and so much other stuff that's going on with this company. And we talked about it in today's discussion call, and I labeled it as a speculative play. I said, yes, I am buying SoFi in 2025. And I said that I'm seeing it purely as speculation, not as something that I can depend on, not something that I call a safe bet or even a safe stock, in my opinion. So I'm going to talk about my thought process behind that company and why did I say that. So I think one of the questions I see here is, Deepak, why did you call it a speculative play? And number two, how are you valuing this company? So I'm going to talk about those two things today. It is possible that all my thesis is completely wrong whatsoever. So please definitely don't take any action based on what I say in this video. Go do your own research. I only tell you how I think about my personal investments. Your style could be completely different. For that matter, we talked in a great deal today about you should never rely on somebody else's thesis. You should never rely on somebody else evaluation. You should kind of come up with your own thesis and your own valuation. So that applies to me as well. So just because I say something, don't go take an action on it. Do your own research, do your own digging, and try to figure out if it makes sense to you or not. Now, we did talk about how why we should not rely on other people advice. So I will make a separate video if you want to hear about those thoughts, why so many people lose money just by simply listening to others. So I don't want you to do that. Take the information, make some sense out of it, and then apply it in your own life as you feel fit. But once again, as a disclaimer, I'm not an investment advisor. Anything that you hear in this video is purely speculative in nature. Use it for information and entertainment purpose only. My name is Deepak, and I'm a tax code advisor. So if you are anywhere in the country, you need some help with taxes, you want to lower your taxes, or you want to need some help with filing your taxes this year, then definitely reach out to me. I'll be happy to help. Just go to taxcodeadvisors.com. My goal is always to provide more value than anybody else out there. That means doing your taxes at a very reasonable rate, but more importantly, deliver more value than just doing your taxes. That's why I do discussion calls, make these videos, and try to get some good information out to you. So that way, you get your money's worth. That's the idea. All right. Having that said, let's talk about SoFi. Why did I call SoFi a speculative play? Well, number one, they're still fairly new. So I want to see a long history. That's not there. Number two, I still have profitability concerns. Although they're doing very well, they're executing very well, but there is an increased competition in fintech, generally speaking. For example, traditional banks can squeeze them, even other online banks can come up. And after all, it's technology, right? A lot of other people can build technology. So they still have a lot of competition. Then they have regulatory problems, changes in fintech regulations, banking licenses, student loan policies, all of that can affect SoFi as well. The regulatory landscape for personal lending and cryptocurrency services is obviously uncertain, and that can also pose legal or compliance challenges. So it's not, I mean, banking is not easy. It's a very highly regulated industry, so you have to be careful with that. Then interest rates, right? SoFi operates in lending, and as you guys know, anybody who operates in lending, revenues are highly dependent on interest rates. Now, SoFi is an exception because even when interest rates were so high, SoFi is consistently able to grow their business and their profit. That's why I like it to begin with. But generally speaking, if you're in lending business, we got to understand that when interest rate goes high, not that many people are borrowing, so there's a problem. So rising rates can obviously lower the demand and increase loan defaults as well. And I'll talk about that in case of SoFi, why that might be a good thing. So that'll be kind of interesting. As the growth-oriented fintech company like SoFi grows, it becomes very, very sensitive to broader market sell-offs. So if S&P 500 goes down, NASDAQ goes down, or Trump says something, there could be a huge sell-off. For example, recently, I think one analyst made a comment that SoFi is overpriced. Right afterwards, the stock start getting sold. So, and that's why I say that it's not like a safe bet. There's plenty of risk with it. Then competition. I think somebody mentioned it on the discussion call as well. These banks not going to sit around and wait. For example, bigger banks like Chase or Wells Fargo, they can try to steal their business as well. But let's just forget about them. Let's just say they're not even paying attention to SoFi. They don't care. Different business model. You can argue with that, right? But what about other products like PayPal, for example? PayPal already have a lot of customers. What is stopping them from copying SoFi model and getting into that? So there could be an opportunity there. What about Robinhood? Robinhood, a lot of people have been using that on their phone. A lot of young generations, like exact same customer demographic as SoFi. So Robinhood can decide to go into that. Again, another fintech company. So what I'm saying is it's not like a cakewalk just yet. And then there's a customer acquisition cost. If you take a look at SoFi financial statements, you will notice that I think, for example, last year, let me pull that up here real quick. I think they did about $2 billion in gross profit and $720 million in sales and marketing expense. So a lot of expenses right now going in sales and marketing, which I don't necessarily have a problem with, because over a long term, they would not need that much sales and marketing, and that will help them increase their earning per share anyway. What I do worried about is a lot of their loans are to students, and students oftentimes have a lot of defaults. So that kind of gives me a little bit of a problem. And then at the end of the day, it's a financial market, and financial markets are extremely hard to operate. So there's plenty of risk in this company. That's why I still call it a speculative play. But I love speculative play. I mean, if I don't take a speculative play, then my earnings or my returns are going to be limited to market return. So if I want to do something beyond that, then I do need to take a little bit of a risk. And that's why I am going with SoFi in 2025. So now, that kind of gives you ideas as to what I don't like about SoFi. Now let me talk about what I do like about SoFi, and then I will talk about some of the valuation and some stuff that's going on with the SoFi. Now, some of you guys who are brand new to the channel, please understand that don't use this channel as a stock tip channel or some sort of investment advice channel. I talk about all kind of stuff. In particular about saving your taxes, building a strong retirement, building a strong education plan, and building long-term wealth. I guide people to not take too much risk, evaluate their options, and make the right decisions. I am against lottery picking. Personally speaking, if you like that, that's good. But I don't want, personally, I don't like to go pick stocks that can 1000x overnight. I'm not that kind of guy. I want to see some history. I want to understand the risk associated with it and take some baby steps. I want to just make a little bit more than market, and that's about it. I'm happy with that. So anyhow, if you are that kind of a mindset person who wants to limit your losses and you want to understand finance in general, then this can be a great educational channel for you. But if you're looking for some hi-fi stocks that can 10x in 2025, I'm not your guy. That's some other channel. All right. So let's talk about upside with SoFi. So number one thing is they consistently are increasing their revenue, and you can see that in their financial statements. They come out and boom, for several years, consistent revenue increase. That's awesome. That means they're scaling in lending, they're scaling in investment, they're scaling in banking. So they are doing very, very well. So I like that execution. Other thing I like about the company is they're very well diversified. They have different revenue streams. They're not only dependent on interest income or loan origination fees or banking fees or anything like that. They have multiple income streams. That's awesome for a company. So it's kind of like a company itself is diversified to a large extent. Then SoFi is not just a fintech company, but they're actually a bank. They have a bank charter approval. That means is that SoFi charter, basically the banking charter allows it to hold customer deposits directly. And when they are able to hold the funds directly, that lowers the funding cost. That means they can take that money and allow somebody else to borrow it. This improves their margins on their lending business. And now they're actually becoming a marketplace. So not just that they can lend their own money, they're allowing their borrowers to use other people's money. So that's only going to increase their net profits even more. Membership. So SoFi is kind of like a Costco. Any of these sites, SoFi, almost like a SaaS company, basically. You get a customer in, and then they keep selling on a regular basis to them. So basically, each additional customer they gain, they have an opportunity to resell them some product for years and years and years. So this membership model is awesome. So SoFi aggressive customer acquisition strategies are driving growth in membership, and we can see that a lot of that is coming from their marketing budget, and people are just super impressed. The analysts, investors, they're just happy with the growth SoFi is able to produce. And they have like a full ecosystem when we talk about the banking stuff, right? Like I said, they are into banking, they're into lending, investments, credit cards, uh, so much stuff. Just go to sofi.com. I mean, do you guys remember those companies we used to use to do our credit checks and budgeting and all that kind of good stuff? You can do all of that stuff these days for free on SoFi. So if you haven't really experienced it, I would say just go use it as a customer so you kind of get a feel of what this company is doing. SoFi did an acquisition recently, so they understand that they need to buy companies to grow really really fast. So they are willing to do that. So they are buying some. I think last year they did a couple of acquisitions that is helping them quite a bit. And then more importantly, generally speaking, there is a tailwind for fintech. And we talked about it even last year in discussion calls as well, that financial sector is going to see some help. Trump administration is going to be friendly when it comes down to finance is concerned, because he wants to grow the economy. He wants to help small business. You know that he's a very business friendly president. So I think fintech by default is going to see some good tailwind. And more importantly, you guys know that already. I don't have to tell you that. Is most people are expecting to get rate cuts, right? We already got a couple of rate cuts. Economy is still strong, but nonetheless, we're hoping in 6 months, year time frame, maybe we are going to see more rate cuts. When we get more rate cuts, what happened? Borrowing increases. When borrowing increases, company like SoFi makes tons of money. So again, more tailwind coming for this company. Um, SoFi is very popular in the student community. And these students, even though they're today students, 2 years, 3 years down the road, they're going to become adults. So are they just going to let go of SoFi? Probably not. They're going to continue to use that product. So maybe many of us are not using SoFi today, but the product is very popular with kids, and when they grow, they continue to use that product. So I think there could be a lot of opportunity there as well. So and like I said, they're going into a lot of new markets right now. So they're experimenting with a lot of things. For example, they're experimenting with credit card, home loans, and now even crypto trading. So uh, so they have a lot of tailwind going for them. And more importantly, SoFi could also either do more acquisition for other fintechs, or maybe SoFi could itself become acquisition target for a larger financial institution. I wouldn't be surprised if Robinhood, for example, might want to buy them, or PayPal might want to buy them. So there are a lot of good stuff going on for this company as well. So let me remind you guys, as far as risk is concerned, there are some profitability challenges. Would they be able to increase those profits, as the market is expecting? There are some regulatory hurdles. They might run into some troubles. They are interest rate sensitive, although they proved everybody wrong and they were able to grow in spite of the fact that interest rates grew quite high in the last couple of years. Then there is competition. After all, it's a software, so that is a problem. And then dependency on a particular segment right now, like student loan, although they are diversifying in a lot of other categories as well. On the upside part, like I said, they have very strong revenue, very good margins. Their membership growth is phenomenal. They're adding new people left and right. They are now very much diversified into different products. They have a banking charter, and they're expanding into new markets. It's only a matter of time before they go into Canada, Mexico, Europe, Asia. I mean, they can go everywhere, their product, because it's just so simple to use. So I do see a lot of potential with this company, but at the same time, it has a lot of risk. That's why I call it a speculative play, but it's a calculated speculative play. So I hope that makes sense for you. Now let's take a look at the valuation of this company. Now, before I go there, I think I made this point, but I want to make sure everybody understands this. There is a very high probability that this company is going to see huge earning per share expansion in 2025, in 2026. Why? Because before, SoFi was only making a little bit of money by sending customers to different loan providers. But now they have converted their product into like a marketplace, and they are charging way, it's more like a partnership kind of arrangement, and they're able to make more money for each loan. So as a bank, you have a limit as to how much you can lend. Depends upon how many deposits you have. You can't just lend unlimited, right? You need to make sure that your bank is safe. SoFi has reached a critical mass at this point. They have more demand for loans than their bank can provide. So now they're partnering up with other people. So imagine being able to make money on other people's money. So that's why I think the market will be surprised to see what kind of earnings SoFi will show in 25, 26. I think last time I checked, their EPS is almost 17 cents for 2024. I think in 2025, it could be 50 cents, 60 cents, maybe even 70 or 80. So this could be a huge in 2025. I mean, I wouldn't be surprised if the stock can go almost 100% in this 1 year alone. But again, please, this is all speculation based on what I said. It's not an established company yet. It comes with plenty of risk. You can literally go to zero. So when I invest my money in speculative companies, I understand that it is possible that that investment will go to zero. So if you're not okay with that, then these are the kind of companies you don't want to touch, even though they offer huge upside potential, but there is just so much risk associated with it. All right. I hope I made that clear and answer the question why I call the companies speculative in nature. Now let's talk about valuation for a second. So let me pull that up here. So let's take a look at the company itself. This is their own report. You can go ahead and go to their website on SoFi for investor relations, and you can pull it up for yourself. I'm looking at the Q3 report. The Q4 should be coming out anytime soon as well. So this one was in October, so we can sort of depend on that. And we can see, look at their members. They are at 9.4 million members now. That's a lot of members. That's like a Costco, basically. They're adding new people left and right into their ecosystem, almost 35% year over year growth. So this is beautiful. And I think if we take a look at by the end of the quarter four, this number might be close to obviously 10 million. So this would be awesome. I mean, that's a lot of people in their ecosystem. Product wise, you can see they're growing, they're diversifying, adding new products, so looks very good. And overall, I mean, I'm not going to bore you with all the details. You should really download this report and take a look at it on your own. And you'll see the company is just doing really, really good job in executing their strategy. So very, very nice. They're a really good candidate for acquisition to companies like Robinhood and PayPal. Like I said, they might pay premium dollars to have this company, to have this kind of product, because that can bring a lot of value to them. But I think it's too early. If I were the member of SoFi management team, maybe I don't want to sell it just yet. I want to probably grow this company for another few years to get to a point where I can make tons of money. So I don't think they will be selling it out right now. So let's just take a look at it for 2024, what their guidance looks like. So we expect to deliver net revenue growth of more than 80% versus 2023 levels. So we got to see what do they say when the next the guidance comes out in few more days here. Lending adjusted net revenue of at least 100% of 2023 levels, and obviously I think the lending adjusted revenue will grow as the interest rate comes down, in my opinion. Adjusted net revenue from 25-50 million. Let's see, what am I? Okay, so earning per share about 12 cents. So far they're saying, I think last time I checked, they're close to 17, 18 cents right now. So that's what it looks like, but you can kind of spend your time. But they have consistently beat whatever they have provided in guidance. So definitely pay attention to this report. Having that said, how should we value this company? So we have tons of metrics that we can choose to value a company, right? We can look at it from so many different ways. I personally like to see cash flow. I like to see book values and so many other metrics to value a particular company. But it's a growth company. So if I take a look at their cash flow, it's not going to look good. I mean, that's negative 1.16 billion. That doesn't attract me. But what I do like is a good revenue growth for the company. I do like the great profit margins. I love that. And most importantly, they're profitable now. They're actually having an earning per share. So I like that. They're spending a lot of that money in sales and marketing. So if they were to, let's just say, become even more profitable tomorrow, they want to deliver better results, all they have to do is stop spending money on sales and marketing, and this number will look good. I don't expect them to do that. I think the idea is they want to bring a lot of people into their ecosystem, and so that way those people start using their products and services and their profitability goes up. So the only thing I need to really worry about for this company is what kind of earning per share they can deliver in 2025 and 2026 and so forth. And as long as they can maintain their growth, that means my multiple on the company will be really, really good as well. So how would I look at it? So right now, earning per share is almost 18 cents. The PE ratio is about 80. So stock is trading roughly around 14 bucks right now. Okay. Um, Now, the problem here is that this PE is super high. So somebody can argue that, for this, maybe the PE should be 10, and maybe because they're fintech, maybe it should be 15. So maybe the stock fair price is $9. So, sorry, not $9. If I was look at today, it will be more like $3. But that's just not fair because the company is just growing way too fast. In matter of fact, for 2025, I have seen different expectations of earning per share, mainly because people are expecting that company will generate more revenue from origination fees and interest payments and so forth. And expectations has been anywhere between 30 cents all the way up to 60 or 70 cents. So let's just say if I look at 30 cents, right? If I have 30 cents and my multiple is still 80, that means the, market remained the same, the stock price is now almost 24 bucks. So still pretty good for 1 year, right? Not bad. All they have to do is increase their earning per share and maintain the growth. And market is very happy and we are rewarded nicely. Another option is this company does very, very well, and they actually bring 60 cents in valuation, in earning per share. And if they do 60 cents and if my multiple remains the same, I end up at 48 bucks. That's very nice. Now, this might happen in 25, it might happen in 26, might happen in 27. So it can happen. But the faster it happens, the more multiple I'm able to get, right? Because if it slows down, the multiple will slow down. Let's say if this happens in next 3 years, maybe people are not willing to pay 50 multiple. Maybe they pay, not 80 multiple. Maybe they'll pay 50 multiple. So at that point, I'm at 30. Okay. Or let's just say if it happens in 5 years. Okay. And if it happens in 5 years, and let's say the earning per share is a little bit more, let's say it goes to almost 80 cents in 5 years, and my multiple goes down to 30 bucks. Now I'm still at 24. So still not bad. So you kind of have to do this math and figure out what your earning per share looks like and what kind of multiple you can drive. So this can be anywhere. So like we talked about it on discussion call today, when I come across these kind of companies, I like to do dollar cost average. So let's say if I wanted to put $10,000 in it right now, I would not do that. I'll probably start with very small, maybe maybe 500 bucks. And then I'll start doing dollar cost averaging. Maybe I'll do it once a week, maybe once a day, maybe once a month, depending upon what my risk appetite look like. So that's how I will manage that. The idea is that if the multiple starts going down, if it goes to, let's just say if it goes to 60, maybe I'll increase my dollar cost averaging. If it decrease more, 40, I'll increase it more. So the more the multiple goes down, the more I will increase my dollar cost averaging. So that's the way I manage that. The idea is that if this company works out, it's going to work out in very long term, right? So I don't have to worry about paying a little bit more or a little bit less in a shorter period of time. Similarly, if this company continues to grow, let's say the next quarter they come out and they say, look, for 2025, our earning per share going to be 80 cents, let's just say, for example, hypothetically speaking. Market going to be super happy and this stock is going to go on a rocket ship. It's going to go from 14 to 50, 60 bucks in no time. So just be aware of that. We just don't know. Everything depends upon what company is going to tell us in that earnings statement. Now, obviously, stocks don't go overnight. Maybe they grow by 20, 30%, but over the longer period of time, market catch up, that information starts to float around and people start paying attention to it. So if I was investing in SoFi, what I would be doing is paying attention to that earning call and paying attention to what does company tell me about the EPS? How would that look like in 2025? And that is how I'm going to value the company. Now, Another major point I want to talk about is that normally when you're looking at growth companies, it's not a good idea to look at them yearly basis. You're better off looking at them 5 years down the road. So that will give you a little bit more better valuation than if you just look at the yearly price. Because if you come up with a number for yearly and stock goes down, you might want to get out of it because you're just not happy, did not meet your expectation. But growth companies take time. They can run into challenges. They can run into problems that can slow them down. It's natural. It does happen. So you really need to learn how to adjust your risk. And as I talked about in the discussion call, I adjust my risk by taking a very small position in a speculative stocks, and I put most of my investments in more safer stocks. So that was my take on SoFi. I hope this was helpful. You're able to do these kind of calculations on your own. You're able to kind of come up with your own number. Take a look at the revenue growth. Take a look at the margin growth. Take a look at how company is innovating. How are they different than other banks? And then figure out on your own, what do you think the earning per share going to look like? You can take a look at the estimate. You can take a look at what company guidance is. But based on what SoFi is doing, what that earning per share looks like. Honestly speaking, from where I am standing today, the way I look at it, if SoFi can survive, right, and they're able to continue what they're doing, it is going to be a great company, right? But if somebody steps in and they try to capture the market share from SoFi, that can be the end of the company as well. So it can go both ways. And I'm putting this out because oftentimes if you go YouTube and or some other places and you will just search for SoFi, you're going to find most of the content that is going to be very provocative in nature, and they'll say why it's a great company and why it can do 10x or 100x or whatever x it is. But like I said, what they're not talking about is risk. So you do need to understand the risk before you make any judgment calls. So once again, guys, my name is Deepak. I'm a tax code advisor. I'm not an investment advisor. I'm not here to tell you what to buy, what to sell. I'm just giving you how I look at the companies and how I make my own decisions. If you need help with taxes, then certainly reach out to me via taxcodeadvisors.com. Thank you.